Did you know that you can actually get a 3% interest rate in 2025? Let me tell you how. There are a few ways to do this, but someone in my DM specifically asked about the buy down using seller credit, so that's what I'm going to talk about in this video. Have you ever wondered how the new construction builders are able to offer really low interest rates as an incentive to purchase a home? That is because of the buy down. So these buy downs basically is the seller giving contribution to closing costs, and a lot of times that contribution can be used to buy down your interest rates, meaning they are paying for your interest rates ahead of time. You may be wondering, if you have the funds to pay down your interest rates as a buyer, are you able to do that? Unfortunately, this is only something a seller is allowed to do. Only a seller can buy down the interest rates of their buyers. So what is a buy down? There are two types of buy downs. There is the temporary buy down and the permanent buy down. With a temporary buy down, you can work with the lender to determine how you want this to go. So let's say your seller gives funds to contribute to your closing costs, and you want to use those funds to buy down your interest rate. You can do something called a 2-1 buy down, a 3-2-1 buy down, a 1-1 buy down, a 1-0 buy down. Basically, what this means is every year, if you have a 3-2-1 buy down, the first year you would get 3% less on your interest rate. The second year, 2% less. The third year, 1% less. And then after that, you're paying the full interest rate. Let me give an example. Let's say today's interest rate is around 6.75%. If you do a 3-1 buy down, you would be paying 3.75% interest rate this year. The next year, you'll be paying a 4.75 interest rate. And then the year after that, you're paying a 5.75% interest rate. And then after that, you're paying the full 6.75% interest rate. 9 times out of 10, that's what the builders are doing. They're doing temporary buy downs. So your interest rates are not going to remain 3% for the entire duration of your loan. With a permanent buy down, it's a little bit different. The seller contributes 1% of the entire loan per point. So if your interest rate is 5%, for example, and you want it to go down to 4%, the lender would say the seller should pay 1% of the entire loan in order to pay down 1 point of your interest rate. So if the cost of the loan is $500,000, the seller would have to put down 5% towards closing costs in order to buy down 1% of the entire loan. Now, if you want the seller's contribution to go towards a permanent buy down, it will cost slightly more. So if you wanted to do a 1-0 buy down for a $500,000 house, it will probably cost around $3,000 to do so. However, if you want to do a temporary buy down, it would cost about $5,000 because that's 1% of the entire loan. Would I advise doing a temporary buy down or a permanent buy down? If you don't think that you're going to remain at this house for a long time, I would suggest that you do a temporary buy down. If you believe that you will be refinancing on your loan anytime soon, I would suggest a temporary buy down. The reason why this is because it costs more money to buy down the entire loan permanently. So I found a calculator online that can show you different types of buy downs and how much it'll cost to buy them down. I found this calculator on PennyMac. If your loan amount is $500,000, the current interest rate is 7%, and your loan is going to be for 30 years, this is how much your principal and interest are going to be, $3,327. Now remember, principal and interest does not include taxes and insurance, so keep that in mind, okay? So it's definitely going to be more than $3,327. This calculator shows that the seller will be buying down the cost that would be saved when your interest rates are being saved. For example, with the 1-0 buy down, which means only on the first year would you get a buy down for 1% less than the actual interest rates right now, you will be saving $3,945 a year. So with that, the seller would need to put that exact amount down on your closing costs to cover that 1-0 buy down. I hope that makes sense. With a 1-1 buy down, which means 1% the first year, 1% the second year, you're going to be paying $2,998 for both years every month, and you're going to be saving $7,890 for 2 years. The seller is going to have to pay that. With a 2-1 buy down, it's similar, except the first year you're paying 2% less, and the second year you're paying 1% less, and then afterwards you're paying the regular interest rates. That would be $11,654, and you would be saving that amount in both years. And the same with a 3-2-1 buy down. I hope that makes sense.